Hello, good morning, good afternoon, good evening, everyone, and welcome to this panel discussion live stream on Twitter, YouTube, LinkedIn. Thank you, everyone, for joining. The topic of today is the end of idle capital, organized by p2p.org, and we are honored to have some amazing guests that, without waiting, I'm gonna introduce and give them like a minute to introduce themselves as well. So let's start with Camila Russo, the founder of the Defiant. We have also Nader from Eigenlabs and Keen from Lido Finance. Thank you very much, guys, for joining us. It's a pleasure to have you here. I'm sure we'll have an amazing and very interesting conversation. Can you please, for the audience, give a quick intro of yourself, even if most of them would probably know you or have heard about you with everything that you're building in the space. But if you can, please. Shall I say ladies first to be a bit, you know,
Mhm.
gallant or conservative? Camila, if you may give us the honor.
Yeah, of course. And thank you so much for having me. So I'm Cami Russo. I'm the founder of The Defiant. What I would say is the best source of news for DeFi and Web3. We focus on the more crypto native and on-chain economy side of crypto. Um, we have newsletters, podcasts, uh, and so on. I also am the author of The Infinite Machine, the first book on the history of Ethereum. And yeah, previous to that, I was a reporter at Bloomberg News for many years.
That's awesome. Yeah. So you started in the TradFi space. Now you are here for a couple of years in the DeFi. We'll ask your basically your view on how can people transition or what is the conversion points between TradFi and DeFi. But that's definitely at the heart of the topic today. Thank you for joining and welcome again. In, can you make us the honor as well?
Sure. My name's Keen Gilbert. I've been in crypto for around 9 years. Started my career in Deloitte doing FS, capital markets consulting, mainly focused on blockchain. After my time in Deloitte, I joined Consensus. So I was there for around 5.5 years, mainly working on MetaMask institutional and Fura staking and a couple of other products. After Consensus, I joined a small startup for a while doing portfolio and risk management for crypto funds. And now currently I'm at Lido, where I'm head of institutional relations and I lead Lido Institutional. So effectively our mandate as a team is to help grow adoption of stETH among institutional clients. So by that I mean different crypto funds, asset managers, hedge funds, ETP, ETF issuers, really anyone who has a significant amount of ETH. And we obviously encourage them to stake with Lido for the added benefits of liquidity and capital efficiency.
Awesome. Thank you very much and welcome again. And yeah, to finish, I mean, like we have another, I would say, super heavyweight champion in DeFi. Nader, if you can also quickly give a quick intro of yourself, even if I know lots of people knows you.
Great to be here. Big fan of everyone here, actually. So, and I'm like interested in this topic. It's a little bit different than some of the stuff that I've been talking about because I'm typically focused on the developer part. But yeah, I'm the developer relations director for Eigenlabs, which is the team behind Eigenlayer Protocol and Eigenlayer. I'm sorry, Eigencloud. And I've been with the company for about 2 years almost now. So I think it's like a year and 10 months maybe. And I've been working in crypto for almost 5 years. Aave, with Graph Protocol, and also Celestia before Eigenlayer. So excited to be here and looking forward to chatting with everyone.
Awesome, awesome. Thank you. Yeah, very excited to be here as well. What I like about today's topic actually is that in many different discussions, we talk about what happened in the past, how we grew to where we are today. And if I give the example of p2p.org saying, yeah, we are a staking operator. We today handle $10 billion plus of assets under staking. This is the kind of metrics that comes quite often in discussion, what we achieved, what we handle today. But today's topic is more about what is missing, what is not efficient, and what we can do better. And from everything that happened today, what is the latest innovation that will unlock this huge potential. So that's why I'm personally very excited to discuss about this topic entitled "The End of Idle Capital," and we will structure this conversation into, let's say, three different parts. First, I want to have like a general intro and have our guest to give our guests the opportunity to give their feeling on what is the general status of the market as per their opinion, how they feel, what they think is going to be important the next 3, 6, 12 months. And then we'll go into a bit more technical aspects of the which is typically a game changer, which is account abstraction and what it means for this idle capital. And based on the time we will have, we'll either spend a bit more time on the technical aspect of the infrastructure and maybe discuss a bit more on the compliance and regulatory. But yeah, let's start with this general feeling, general overview. Guys, how do you feel today? The market is very interesting, but what's your opinion? Well, how do you feel today in this current market situation? Who wants to start? Very generic question, but yeah, it's going to set the tone of the discussion.
I'm happy to start. I think, Yali, like you said, it's definitely an interesting period with the price volatility that we're seeing. I was actually in New York, I think a couple of weeks ago at SmartCon, and it's always nice to kind of see people face to face. And I definitely felt like the sentiment was different than it was probably 3 or 4 months ago. I'd say 3 or 4 months ago, it was very bullish. The price was only going up. And then obviously the amount of liquidity that left 3 or 4 weeks ago, that I think it spooked a lot of people. But one thing that I definitely noticed and hadn't spooked was the institutions. Like, again, this is just a small blip. Like the BlackRocks of the world, the Fidelities, the big DATCOs, they're here for the long term. And getting a chance to meet those guys face to face compared to retail, it's, again, nothing has changed from their perspective. They're here to stay.
That's interesting to know. I'll dig deeper on that. You mentioned like few things that I want to question about. But Camila, how do you feel today?
Yeah, yeah, similar to Keen, I think it's clear that the sentiment has shifted to become a bit more bearish, with prices declining. Recently, we had a couple of big incidents in DeFi, with the Balancer V2 hack, and then Stream and XUSD, DPEG, and all these things, which I think definitely casted a bit of concern in DeFi. And I don't know at which part of the cycle we're at, but I think it's very clear that it's no longer, we're in the middle of a bull run. Right now there is kind of this overhanging concern or cloud on the question of whether the bull run is over. But yeah, I think it's interesting that unlike other cycles, this time around it's the first time that there is actually institutional capital in crypto at the degree that we have today. So the previous cycle, obviously the ETFs hadn't been approved. This cycle we have I think it's between 80 to 100 billion of AUM in ETFs, and I think that provides some sort of floor, at least for the major cryptos. And yeah, I think like once institutions realize the potential and are convinced of the technology, and crypto is becoming more of kind of financial infrastructure, it gives the sector a lot more resiliency. And so I think if we are in a bear market, I think it'll be a lot, it'll be different from past ones.
Yeah, I agree on that. It would be interesting to discuss a bit more. First, I want to let Nader tell us how he feels today.
Yeah, I feel like excited, and it's and everything that everyone here said is true. But at the same time, it's kind of like the longer that you're here, the more that you believe in all this stuff, the less the macro matters, and more about you kind of see the bigger vision. And and in general, like Camille said, we've never seen this level of not only adoption from institutions, but also the embracing of all of this stuff by all of the software companies like Cloudflare and Microsoft and Vercel. And in terms of like what the future holds, that's where a lot of growth is going to start at the very, very like infrastructure level, adoption level of all these like big software companies, recognizing the value proposition of a lot of this technology. Stripe, there's too many to name at this point. So I think that's kind of really, really exciting, and never been more excited than today, honestly.
Yeah, that's true. And I mean, like you are a leader in the restaking space. So how do you feel when you see capital that are typically not producing anything? Because I mean, like your goal, let's abstract from the benefits in security, shared security model and stuff like that of the restaking. Let's think just as the capital optimization point of view. Then we'll go into the technical aspect. Basically, you have the possibility to offer to Ethereum stakers a way to increase the level of profitability while enhancing, like some security models of protocols. How do you feel when you see that some capital is not productive at all?
When I see capital that is not productive at all,
Yeah, from a financial perspective.
well, it all kind of, in my opinion, boils down to risk management, and
Mm.
is 3 to 4%, being staked on Lido or wherever, is that worth whatever risk that might involve? And then would you rather just hold it and hope that the price continues to do well relative to like fiat currency or whatever that would be? So I mean, I think it's all about like risk management and everyone's
Mm.
risk profile. It's hard for me to look at someone that's holding something and say, oh, they should do this or they shouldn't do this. It's interesting to see a lot of the cool DeFi products that come out where people are trying to offer really, really high yield. It's always like so questionable to me, but it's also very inconsistent. Like it'll change, one day over the other. So I think the interesting thing about what you might be able to do with like restaking is that yeah, you might get 3 to 4% on your ETH, and just by staking, and you might want to do something more productive with that. And in order to do that, you typically have to like withdraw your ETH, and then I would say look at other products and protocols, oracles, bridges, whatever networks that you might consider. And then you're kind of like instead of staking, instead of holding ETH, you're kind of moving it around. But with restaking, you can kind of maybe have the best of both worlds theoretically. You could essentially secure the Ethereum network as well as other networks, and you might bring your yield up to double or triple that. So I think it just depends on everyone's risk profile.
Yeah. And do you have an example, like a concrete example, where an institution went from zero yield to an active deployment? Of course, I mean, like for confidentiality reason, we can abstract, like the name of this institution. But if you can walk us through, like a concrete example, perhaps that can be interesting as well.
I think the most recent example might be like SharpLink. They
Mm.
recently announced that they're going to be deploying around, I think, $200 million into Eigenlayer. But yeah, I would say because everything is pretty much public and transparent, you can kind of look and see all of the activity that's happening. Yeah.
Mm. Yeah, that's a very good example. And talking about like a treasury companies, if I can ask you, Keen, I mean, like with Lido, I mean, like you guys process billions in institutional staking today, and when we still see massive treasuries earning nothing. In your opinion, what's the main reason? Typically, when an institution comes to you, what's the number one concern today? I mean, like,
Yeah, I think there's 2 points that come up quite consistently, and the first is security, and the second is liquidity. And like Nader mentioned, Sharplink there, I think they've been quite vocal where they said they want to kind of do everything within the QC at Anchorage. Their earnings call was today, and that's something they really drove home, that they're willing to kind of sacrifice yield in replace of higher levels of security. So again, doing that in a qualified custodian environment. And then on the second point around liquidity, we tend to see kind of two main points coming up. Like these institutions want to know how much they can sell, how long it takes to sell. And from a Lido perspective, it's to be frank, a terrific advantage that we have. Like Lido is a 30 billion TVL, around 9 million each staked, and the depth of liquidity that we can bring to the table, very few others can compete with. So yeah, like to kind of summarize, I would definitely say they're the two main points, like getting integrations or native staking integrations done within the QC, and then showing that there's a strong depth to liquidity there for these DACCOs and other ETF issuers for them to work with.
No, very interesting. Thank you for sharing that. I'm completely join you on that. I mean, like, presenting P2P.org is also kind of makes sense. I mean, like, we are aligned on that. Camila, if I may ask you, with the Defiant, you guys track institutional flows, institutional crypto adoption almost on a daily basis. So what would be your take on how much capital is actually sitting idle across treasuries, institutional treasuries? And
Yeah.
so I will have a follow-up question on that, but I'll let you go first.
Sure. So I think there are many different pockets of idle capital across crypto. Like I mentioned before, I think like the biggest one right now are ETFs. And because of regulatory reasons, staking hasn't been allowed in ETFs in the US yet. So I think as soon as we have an ETH staking ETF, that's bound to change. But right now, we have Bitcoin and ETH. Like most of AUM is in Bitcoin and ETH ETF. So I believe that's about like 80 to 100 billion of AUM. Next, we have the next big bucket, I think, of idle capital is sitting in corporate treasuries. And this is a big kind of wave that we saw this year of more and more companies actually holding crypto. So obviously, Strategy, previously MicroStrategy was the first, major one. But we've seen other ones with Tesla and more like crypto native companies like Galaxy, Coinbase, of course, and others. And those corporate treasuries, probably in the tens of billions of crypto held. And the next are just, like the custodial, like institutional custodial platforms that are just holding Bitcoin and mostly Bitcoin, but also other cryptocurrencies for institutional clients, family offices, funds, pension funds, and so forth. So yeah, things like Anchorage, Coinbase, Gemini, like all those big institutional custody solutions. And yeah, I would the estimates are also another kind of tens of billions in those solutions. So you have like all these big buckets of idle crypto. So yeah, ETFs, corporate treasuries, and just institutional custody solutions. And yeah, I think like what we've been saying here, the first step was to get institutions comfortable with just holding crypto, and I think that's happened this year. So we have that, and that's growing, and we'll see more and more of that. And I think kind of the next step will be to make that crypto more productive.
Yeah, and what do you think? I mean, like, what's the real cost of these inactions? I mean, like, is it only like a loss of opportunity, or it is really like a threat for the ecosystem? How do you see that basically, and how you evaluate like the real cost of these kind of inactions?
I mean, it's obviously the main one is the obvious one is the cost of opportunity of not having that crypto earning yield in what now are very battle tested solutions like Lido.
Mm,
Right now there's I think 30% of ETH around is staked. So
mm,
there is a lot of liquidity. There are good solutions like Lido and Eigenlayer. So it's like more than like tens of billions and even hundreds of billions of dollars in crypto that could be earning yield. Um, I think that's probably the main one.
all right, yeah. Yeah, thank you for sharing. Thank you, everyone. I think that was such a great introduction to the topic, and we kind of discussed that things are changing, things are evolving, and there is constantly some new also technical innovation in the ecosystem. One that we want to discuss about today is account abstraction. So the question is it really a game changer, or is it just an innovation that is basically still blocked by other constraints? Could be regulatory, could be risk management or whatever. But I want to discuss about like account abstraction. So yeah, so perhaps let me start with a question perhaps for you, Kin, if you don't mind. So liquid staking through account abstraction can enable automated compounding and rebalancing. Uh, Basically, in terms of volumes, what percentage of your institutional volumes come through account abstraction today?
Yeah, like to be honest, I would say it's quite low. Like out of say 100 conversations I have with clients, maybe 2 or 3% would bring up the topic.
Yeah,
To kind of what Camilla mentioned, most of the excitement and interest seems to be around the ETF. And I think that's getting more excitement right now because the ETF is basically a wrapper or financial product that has precedent that people trust. Whereas on the account abstraction side, a lot of the traditional players are still trying to wrap their heads around it. And
yeah,
again, like with the ETF, when staking is approved, and more importantly, when staking gets added to these products, the real question will be what percentage of the product will be staked. So, like with BlackRock's Ether product, I think that's a 10 billion AUM product. Will 50% of that AUM be staked? 60%? I think that's what a lot of the institutions are looking at right now. Like, how much additional value will that staking actually add? And I suppose how much of the staking rewards will the actual issuer pass on to clients? But yeah, like I said, it is relatively low right now, 3-4%. But I would expect in the next year it'll probably double.
Okay, yeah, still double. But as you mentioned, like ETFs, do you still think that this would be the path that those like traditional institutional player will follow?
I think if they're a traditional institution, it just makes a ton of sense. Like it's so easy to
Yeah.
buy. It's so easy to buy units of an ETF, go to your brokerage, put in a buy order. And of course, if you're not exactly crypto native, it takes away all the complexity. You don't have to go and on board with a custodian. You don't have to go through the hassle of working with a node operator, as terrific as P2P is. It just removes so many barriers. But like I said, the real question for a natively staked ETF is what percentage are you going to get staked? Like if it's only 50% and the staking reward rate right now is, let's say, 3%, suddenly you're only getting half that. Whereas, say, what you could do with liquid staking is this idea of having 100% stake product. So you're passing on the full 3% staking yield because, again, like Steth is heavily liquid. The reason these ETFs keep quite a large portion unstaked or liquid is to handle redemption requests. And given that the withdrawal queue right now is probably 35, 40 days, these ETF issuers typically have to operate on a T+1, T+2 basis. So having a large proportion of the product stake is just not going to meet the requirements set by the industry.
Yeah, yeah. I mean, like Lido recently, I mean, like partnered with some ETF providers. Do you see the direct impact this has on basically on the volumes of demands, or did it triggered, like demands from other institutional coming to replicate the same? I mean, like on especially on the Ethereum side. I mean, like as you guys focus on that.
Yeah, it's really exciting. So a couple of weeks ago, Van Eck filed their S1 form for a Lido staked ETH ETF.
Correct.
So
Yeah.
that would be 100% stake product. Um, I think the exciting part of that filing was, one, it got terrific attention. It showed to
Mm,
the market that, look, like Lido is doing as much as anyone to help bring DeFi to traditional finance. And what's really cool about that filing is that the idea would be to use Lido Core. So the idea that when ETH is being staked through Lido's middleware, it's distributed across 800 node operators. It's not just
mm,
staked with one single node operator, which of course comes with centralization risk. So from my perspective, and I suppose probably Lidos as a whole, like we're really trying to practice what we preach. And that's really what is exciting about that ETF filing. Um, I should say from a European perspective, like staking has been around in these products for quite a while, but they have the same issue that the US will face, like what percentage of the AUM will be
mm.
staked. So again, this narrative of using Lido and liquid staking is hopefully going to pick up a lot more. And this idea of increasing the staking rate from say 50 to 90%, depending on
Mm.
the institution that we speak to.
Oh, right. Yeah. No, thank you for sharing. Camila, if I may ask you same on this topic, and also to go back on account abstraction. I mean, like you probably shared thoughts with hundreds of institutional players, whether it's casual discussion or interviews, etc. Uh, would you join in on his view on the ETF, or you think there is still some very underappreciated benefits of account abstraction that institutions are just starting to grasp?
I would agree with Keen that right now account abstraction isn't in, big institutional players kind of horizon, or they're not really looking at it very closely. Like I said, I think this year has been about institutions getting comfortable with crypto and holding crypto.
Mhm.
I think even staking is like then a step, would be a next step, and account abstraction would come after that, I assume, because it's still a very early and nascent technology.
Mm,
But what I would say is for institutions, so account abstraction, what we all kind of associate with it is improved UX, and I think that's kind of the obvious benefit to account abstraction. But I think for institutions, um, other than UX, that maybe it's not such a big concern for them. I think it's more about governance, what account abstractions could unlock. So the idea of programming rules around wallets, and having a more kind of multi-sig sort of control, and having set balances and spending limits, and all those things that are kind of common in traditional finance, but are just harder to implement in crypto, will be available now with account abstraction. So I think this new technology will be key once institutions become more comfortable on chain. But I don't think at this point it's in their radar. But I think maybe kind of the governance aspect around account abstraction could be like an underappreciated one.
yeah, interesting. And if we talk about like risk, I mean, like Nader, you mentioned just before, like risk management in the DeFi as still being one of the blocker for institutional adoption. Um, I mean, like with eigenlayer that allows slashing conditions to be how do you say programmatically defined. How does this, I mean, like programmable risk management has an impact on institutional appetite? I mean, like, do you think is really like not only a blocker, but an obstacle that needs to be, like um, fixed before moving forward? I mean, like, what's your view on that? I mean, like, if you have perhaps like if you can help like by giving the scenario before, after, and what you think is can happen, or what you think should be done in the next 6-12 months.
Yeah, I think 100% I agree with Camila around like the idea that that is essentially this is just a big UX improvement. Now, whether or not they recognize that and implementing that, it kind of depends on who you talk to and, how advanced their team is and how archaic and how like old their existing infrastructure is, because, moving over to a lot of this stuff is not easy for the older companies with like legacy systems. But I would say in general, it kind of like before and after, you might consider what was done in the past as more of like a manual, very high touch operation into something that's more like automated. So you now can have like automated treasury management. So in the past, institutions might have to have manually monitored like slashing exposure across multiple like products and services. They might have had to like manually coordinate emergency withdrawals when there was some type of like risk threshold that was breached. And this is kind of operationally impossible to do like at scale, right? So with account abstractions, with account abstraction, institutions can kind of like encode their own risk policies directly into the smart contract wallets. So for instance, if any operator gets slashed more than 5%, automatic withdraw and reallocate to like backup operators. Maybe when a slashing event occurs, the account can like self-execute like the risk response in real time, as opposed to needing like manual intervention. So it's again around automation and kind of some of the stuff that Camila was mentioning around how like governance might apply would be the same here.
All right, yeah, and if you want to be a bit more, let's say, practical or tactical, and yeah, thank you for sharing. I mean, like it's very very interesting. But I want to understand. Let's say you have an institution coming to you and they want to deploy hundred millions into risk-taking with automated management. I mean, like, how would you, like, guide them, if you can, walk us through, like the actual steps as a guidance?
Who is this directed towards, by the way?
Yeah, I mean, like, for you, as you presented like this on the, just want to
Like
to dig a bit more, like on the actual, yeah.
Yeah, I mean, this is a little bit outside of my, day-to-day work, because I don't actually interface a lot with these teams. But I would probably say, yeah, you have that board approval. You might have some type of infrastructure set up where, this might be where we actually implement some type of abstraction using account abstraction. You might then go and investigate and do some research on the operator sets that you want to work with. So you might say, I want to put 40% to this conservative data availability layer that has like 5% yield. You might put like a lower percentage to something with a little more high yield, but a little bit more risk, something like that. And then you would essentially just monitor and see what happens from there.
Yeah, Nukin, from your perspective, I mean, like, what would you think? I mean, like,
Yeah, it really depends on who you're speaking to. Some guys can be quite, so for lack of a better term, advanced, or quite happy to take on a lot of risk. Like one strategy we see quite a lot of is just looping stETH constantly. That's quite interesting. There's a lot of risk that can be associated with that. But one thing we've tried to do to kind of address some of these, I suppose, queries from institutions, is that we launched Lido Earn. So Lido Earn is basically a number of different vaults, and you can think of each vault representing like a blue chip DeFi strategy. And we're just trying to make it as easy as possible for not only institutions, but also retail to do more with their stETH. Because again, a little bit earlier on, like Nader mentioned, that the staking part is probably the boring part to a degree. Obviously, like you're doing great things, helping to secure the network, but 2.5 or 3% tends not to be that exciting. So the exciting part comes with what you're using stETH for. So this idea with Lido Earn is that you take your stETH or your ETH, deploy it into a vault, and you're generating higher returns. So one of the examples that kind of Lido launched a couple of weeks ago was Lido Golden Goose Vault. And I think the TVL is already up to 90 million. And the whole idea of that vault as a strategy is that it's deploying stETH into, say, like Aave on Ethereum, Aave on Base. It's, again, just trying to make it as easy as possible for these institutions and retail to do more with their stETH and ultimately kind of generate higher rewards.
It's very interesting. Camila, do you want to add something on that? Or
Yeah, I think these are all great options for deploying your crypto. I obviously, with each layer of each new protocol, each time you loop, each time you go into these vaults and your crypto is deployed in all these different places, you add risk. And there's no free lunch, right? If you're getting a higher percentage return, that's because you're taking on more risk. So I think that'll be kind of the main concern for institutions when considering whether to deploy these strategies or not. I think where we stand right now, I think those will probably be great solutions for more crypto native companies. Project treasuries, maybe crypto exchanges deploying, offering these options to their users, things like that. So yeah, I really see kind of Lido Earn being very useful to a crypto treasury, to deploy a crypto treasury there. But yeah, I don't know. I'm from just talking to like the Franklin Templetons and BlackRocks of the world. Like I right now they're still just starting to tokenize their money market funds, and have them be still in just like very segregated boxes within crypto. But I think it'll take time for just more traditional asset managers to adopt these more more DeFi solutions.
I agree with you. And lots of people are saying, yeah, regulation is still not ready, etc. I mean, like when you really think about it, regulation is also driven by the not just the willingness of those huge institutions to adopt the solution. Basically, if tomorrow you have a Franklin Templeton or those big giants willing to do something, not to say that they can influence the regulators, but the regulators can kind of understand from their needs what needs to be put in place. So I think it's too much. I'm not trying to be provocative here, but I think it's still too easy to say, yeah, it's just because regulation is not ready. No, it means that the players that make things moving are not totally ready. And this can be for many different reasons. That can be technical constraint or lack of understanding of some technical aspects. That can be risk management models or those things that are missing, or perhaps they are just doing just fine in what they are currently doing, and it doesn't hurt enough to make a whole change. That's usually what drives adoption. Well, thanks, guys, for sharing your perspective. I want to finish this section with one little game. Is the game of you have the power to change one thing in 30 seconds. With what would it be? Let's say that can be like a technical update, but let's extend that to anything. If you can, with like a click on a finger, just change something in 30 seconds, what would it be?
Wow, like this would have to be outside of tech. I guess just bringing, everyone in the world to have no worries about like money and food and like health and all those things. But obviously that's impossible. But yeah, that would be the one thing I would change.
Yeah, and if you have to choose one technical thing, and what can what technical like miracle can bring that? Guys, help him. Try you can jump on it. That's the freestyle session. I mean, like it's something not prepared for those who are listening to us. I mean, like I'm just bringing that up. So
I think that for me, like what I would change that would I think would accelerate at just like speaking of crypto, like crypto adoption is if more people earned their salary in crypto, I think that would be kind of the one thing that would supercharge everything, because once you have your own earnings in crypto, then you don't need to go back to fiat. You can start spending crypto, saving in crypto, and then like that would be kind of a domino effect on on payments, on investments, on funds, like all of these things we're talking about. Like I think you're right. I think it's, regulatory changes comes from needs, and kind of from what people are demanding. If more people just have their money in crypto, that's, it'll be a demand for regulators to move to kind of allow all these solutions. So that would be mine.
very interesting. That's a good one. Keen, you want to give yours?
Yeah, if I'm speaking selfishly for a moment, I think it would make my life a lot easier if everyone knew what Lido and liquid staking was. It would save me a lot of time when I'm on calls trying to educate people, because it can be quite difficult to go from like education from people investing, whether it's quite an advanced topic or an easy topic, unless people have an understanding about what they're doing. It's very low likelihood that they will invest. And this is again kind of critical. Like if you're speaking to these institutions that are public, heavily regulated, like sales cycles tend to be 12 months, 14 months. So anything to make things easier from an understanding point of view, it just cuts the sales cycle down dramatically.
That's amazing. That's very interesting. And if I'm gonna ask people that are listening to post on Twitter what they are thinking about that, and that's always interesting to see where we are right now, and what are the things that everyone is dreaming about, that will definitely bring the highest level of satisfactions. Yes, so let's finish, and I'm just checking the time. I mean, like I feel like we can talk for hours around those topics, but let's finish with the path forward. And so how can I turn this question? I don't want to turn it in a negative way, but in a constructive way. So in the market today, what do you think would be the single biggest mistake institutions make when starting their yield journey? And I mean, like in my questions, what I expect from you is to tell me what do you think they should do? What is the common mistake that is done, and what would be a better approach? Same
Well, I'm going to go
freestyle.
first.
You can
I'm
go
not an
wherever you go.
expert. I'm not an expert,
Okay.
so I'll go first so the experts can go and like fix whatever I say that's wrong. But I'm assuming like going too risky or not diversifying enough. Maybe those would be two things that I like. If I was to give some advice, would be to not do. It would be to diversify, and also not to be like chasing like crazy high yields, because there's obviously like something wrong if that's happening.
Thank you for sharing that. Who wants to add something?
Yeah, like to be honest, I'd probably just echo Nader's points. Like it goes back again to security, liquidity, and like diversification. Like if you want to be a lot more risk on and you have everything centralized, that's a huge amount of risk. And I think serious players from traditional finance know how to manage risk and tend to probably mitigate risk a lot better than potentially some of the more DeFi friendly liquid funds. unless they have the skill set from traditional finance. So yeah, like again, I wouldn't be chasing an extra couple of percent, sacrificing risk. In the long term, it tends not to be worth it. And the reputational damage that could follow afterwards, again, it tends to be something you may not recover from.
Interesting. What do you think, Camila?
Yeah, I definitely agree. I think there's a balance. I think like there's a mistake in not doing anything with your crypto and just letting it sit there, obviously. So that's one, but it needs to be in a way that is very conscious of the risk that that you're taking when you're adding when you are deploying that crypto. So I think you know I think I would want institutions to try experimenting with a small percentage of their treasuries and portfolios in DeFi, but obviously, in a way that minimizes risk. And for I think the what we've seen in the past is lack of transparency is a huge red flag. So we saw obviously what happened with Celsius and the big CeFi lenders who were not using their users' capital in a transparent way, and they were reinvesting and relending their users' funds. And the same is happening in DeFi, which was very disappointing to see. These kind of vault managers and curators taking capital off chain and just like doing the same thing essentially that we've been criticizing in CeFi. So I think if you're in crypto, you have the opportunity to deploy capital in a way that is transparent. It's just like very transparent and open protocols. So I would hope that institutions see that as a benefit and go to the protocols and projects that are doing things in an open and transparent way.
And if I want to, and we'll close on that if you don't mind, your vision for 2026. So Camila, for you, what would be what story will Defiant be writing about institutional yield in 2026?
I think we will continue to see institutions take bigger steps in crypto. Like we're seeing them get comfortable with holding crypto, buying more crypto with their treasuries, asset managers holding more crypto, and so I think next year we'll just see a progression of this TradFi DeFi convergence, which just started to happen this year. But I think next year will be kind of a continuation of that.
Well, the good thing is that it's just still just the beginning. So we'll all be here and having more things to say.
Definitely.
I would say that's
Yeah.
awesome. And Keen, I mean, like I don't want to ask you the famous, a bit too cliche question, what success look like for you. So I will just say perhaps one metric that will define success in the whole, from a liquid staking perspective. So next year, what would it be? Which metrics will basically qualify?
Tough question. I think for me, one interesting metric to look at will probably be from like a European ETP and an American ETF perspective. Specifically, like the market share of a stETH ETF versus a natively staked ETF. And I'd be really curious to see if a liquid staked ETF has a higher AUM versus natively staked products. Because again, if the narrative for a liquid staked product is you get the full staking yield, whereas a natively staked product is only 50%, it would be curious to see what people or what percentage gravitate to the liquid staked product versus a natively staked product.
Interesting. Yeah. Yeah, that's a good one. Thanks a lot. And Nader, if I can ask you, as a closing thought, what what would be the use case, the killer use case for institutional risk-taking that no one sees coming, or that is about to come?
Use case. Well, I mean, for us, it's more
Use
about like
case or feature
powering.
or whatever,
Yeah,
yeah, or
yeah,
innovation. I mean, like,
for sure. I think like for us, it's more about like powering use cases, and I don't think people in their head are like, oh, I'm going to take this Ethereum, this crypto, and it's going to be used to enable like AI applications, because that just doesn't like make sense until you understand how the tech works. But that's exactly what I think is going to be really interesting and exciting, because I do think that
Mm.
verifiable AI and the intersection between like AI and crypto is absolutely massive, and being able to essentially stake and power a lot of those services and earn money and earn yield and earn rewards from that is going to be huge if it does take off, or when it does take off. So I think that's kind of the most exciting area for me. And if you're interested in learning a little bit more, like Eigen AI is something we're working on. There's also tons of other crypto companies out there that are doing different forms of AI. There's sentient ritual. There's many other ones that I'm like Tau. So anyway, that's an interesting area for me.
Awesome. Well, let's conclude on that one then. Nader, Camila, Keen, thanks a million for taking the time to be with us today. I hope everyone in the audience enjoyed the conversation. For me, it was a pleasure to have you here. And what I will remember is that the best is yet to come from what you guys are saying. Thanks again, and safe trip to Dev Connect. It's another proof that the ecosystem never stops, and a lot of things are happening even during the weekends. So yeah,
Yes.
safe trip there,
Awesome.
and hope to see you soon. Thanks again.
Thank you so much. This was great.
Thanks so much.
Bye, guys.
Thanks.
Thank you.
Bye.